right, let's go ahead and jump in. Um, Excited to have DJ Mormile with me today, and he's from OneAmerica, regional account director there, good friend of Alpine's and a great partner of ours. And today we get to talk about two of my favorite topics. If you know me, I'm pretty passionate, but these two topics together, I'm very excited about, and that is long-term care and that is saving tax dollars. So that's what we're going to talk about today. Before we jump into the tax strategy, which is really, how the Pension Protection Act can, make non-qualified annuities better when using for long-term care, we're going to talk a little bit about long-term care. So, when talking about long-term care, the first thing that I think is important to understand is that if you ask your clients, hey, what do you think of, when you hear the words long-term care? More people think the word of nursing home than actually think of what it really is. So I think it's important to take a moment and say, hey, long-term care is not a location. It's not about where you're receiving care. It's actually the ability to do the activities of daily living, or whether you have a severe cognitive impairment that might require supervision like Alzheimer's, dementia. So if you think about the activities of daily living, these are the things that we take for granted. We do them within 15, 20 minutes of waking up every day. I mean, think about it. We get out of bed, that's transferring. We go to the bathroom, that's toileting. Hopefully we make it in time, that's holding continence. And then we bathe ourselves, we get dressed, and we eat. And you have to do those things every day. And if you can't do them, somebody's got to do it for you. So that is what long-term care is. It has nothing to do with the location in which you're receiving care. So that's the first misconception that you have to make sure that your clients understand is, hey, what is long-term care and what is it not? Let's talk real quick about the opportunity. This doesn't surprise me, but 9 out of 10 over the age of 65 feel that the financial professional should lead the long-term care conversation. Why? Because nobody's really doing a good job of it. Husband and wife are sitting there watching TV or doing whatever they're doing, eating dinner, and one turns to the other and says, hey, what are we going to do if we get sick and need care? And that obstacle seems like climbing Mount Everest. So they basically say, I don't know. Or they throw money in a CD. Or they have, maybe a non-qualified annuity they don't need, so they'll earmark that. And we're going to talk about how the Pension Protection Act can make that better right there. So 90% of people think that the financial advisor, the professional, should lead the conversation around long-term care. And by the way, it's as easy as, hey, DJ, let me ask you, do you have any concern if you need extended care, if you need care, how do you pay for that care? It's as simple as that. That's the question that creates the opportunity. So it's not surprising that also about 90% of Americans feel that long-term care is important to financial planning, right? That's kind of consistent with the first statistic we just looked at. Hey, it's important and somebody's got to lead the conversation. And then we've all seen the statistics or the AARP article that said, hey, 70% of those over the age of 65 are going to need some form of care. And in fact, 2 out of 10 are going to need it for more than 5 years. The average Alzheimer dementia claim, I believe, is about 8 years. And so this is interesting, right? As a financial professional, what we're seeing when we talk to professionals who have clients who are in need of long-term care services, those advisors who don't have a dedicated bucket that they can reach into and grab income from, a dedicated funding source for long-term care, are seeing the withdrawal rates on the portfolio go from 5 to 11%. Now, how does the healthy spouse survive? And what happens to the assets you manage? So this is all about protecting your client's assets, in turn protecting the assets you manage, maintaining the values of your business. Okay. So, what are the questions that clients need to ask themselves, or really that you need to ask your clients, right? So there's that introductory question that creates the opportunity. Hey, do you have any concern over, how you might pay for care if you get sick and needed extended care? That's the opener. But then the question is, hey, who's going to provide that care, right? This is a great question because roughly 55% of people want to hire somebody, which means basically the other half want family. And so I can tell you that the financial professionals I talk with, the thing that they like to hear the least is, well, we're going to take care of each other, or the kids are going to take care of us, right? It's not the easiest objection to overcome, but there are ways to professionally overcome those objections. I don't want to go too deep into that hole, so we'll keep it moving, but we can certainly help you overcome those objections. The next question they have to ask themselves, you have to ask your clients, get them thinking about is, hey, where do you want to receive that care? Now, we know most people want to receive care at home, but it's important to talk about it. They have to voice that they have to, verbalize it and figure out that's what they want to do. But, some people have to downsize. Some people want to move with into, with their children. Well, do their children know that? Are they one town away, one state away, half a country away, right? Do you know the children? So it's a great opportunity to bridge the generation gap. The third question, what does it cost, right? So now that we know you want to hire somebody, you want to stay at home as long as you can. So what does it cost? This is probably something clients don't know. Maybe they do if they're experiencing it in their family right now. They're experiencing a care event. But we've got a ton of resources. DJ has some that he'll share with us that will help you determine the cost of care anywhere in the country, right? So if you're talking to somebody in, Minnesota and they say, well, I'm going to retire to Arizona. Well, we have the cost of care in both areas and then regionally throughout the state. So, the fourth question, now that we know you want to hire somebody to provide care, you want to stay at home as long as you can, it costs $6,000 or whatever it does to do that. How are you going to pay for that care if you need it? If you need to start writing a check for $6,000 or whatever it is, last month, this month, next month, the following month, however long it takes, what account are you going to write the check from? Now, we have a one-page asset identifier, which does a nice job of allowing you to, list what the cost of care is in their particular region. And when they answer your question of how they would pay for it, what account they would pay for, you write that down, right? Once you've gone through the conversation, you can put the pen down and congratulate your client because they've done more than 90% of people in this country have done. They've vocalized and you put down on paper their plan for long-term care. The question is, when you get back to the office, can we roll up our sleeves and figure out how to make this plan better? Can we create tax advantages? Maybe using the PPA, the Pension Protection Act, which we're going to talk in a minute. And can we create leverage, maybe turn $1 into $2, right? After all, it is life insurance. So you can see that as the client answers, they're basically telling you how they intend to pay for it. And then we can roll up our sleeves when you get back to the office and talk about how we best utilize the plan and make it better. So that takes us to the second part of our presentation, which is really the Pension Protection Act and how it can improve a non-qualified annuity's ability to pay for care. So I'll turn it over to DJ. We'll jump right in. I'll stop my screen share so he can start his. DJ, why don't you take it away once you get your screen share up there?
Sure. You seeing everything okay, Josh?
Yes, sir.
Fantastic. Thank you very much. A great intro, and I love that asset identifier. In the event that the client does wind up putting something down like a non-qualified annuity, because maybe there were one of those clients who decided to self-fund years ago, and they stuffed money into a non-qualified annuity over the course of time. This is a perfect opportunity to go ahead and convert the existing annuity from where it is today to a more tax efficient vehicle that it can be used for tomorrow. And let me go ahead and talk a little bit about this. How we got there, we got this thing that we call the silver tsunami, which is really, and we've all seen the baby boom, we've all heard the baby boomer story. Everybody's getting a little bit older every single day. When you overlay that with long-term care expenses, here's where, in my opinion, I'm a bit of a long-term care geek, it gets really interesting. When I started in the industry back in about 2000, annual long-term care expenses were about $30 billion. About 15 years later, they jumped tenfold, and right now we're in the range of about $500 billion is what the country is spending across the board every single year. Now, I know that these numbers are sometimes a little hard to wrap our heads around. So if you guys happen to remember Hurricane Katrina, I live along the Gulf Coast, and for me, it was a mess for all of us down there. Hurricane Katrina was 250 billion. So the economic impact of what we're seeing from long-term care hitting the country is the equivalent of Hurricane Katrina hitting us 2 times a year, every single year going forward. That's a very scary number. And that's why the government has stepped in and has gone ahead and started incentivizing us to coaxing wealthy Americans to start to plan for care. They came out with HIPAA in 96, the Pension Protection Act, which is what we're going to be talking about today, in 2005. And then from there, we've seen a number of other changes across the board, coming from the IRS, coming from Capitol Hill, and really the idea is just to help us fund long-term care more efficiently. Now, the Pension Protection Act, as I said a minute ago, came out a few years ago, and in my opinion, it's a phenomenal piece of legislation because what it's allowed us to do is use existing non-qualified annuities to fund long-term care. And if we were to take an existing non-qualified annuity that is not a Pension Protection Act annuity and transfer that into via a simple 1035 exchange into a PPA, Pension Protection Act compliant annuity. And what this means is it has specific tax language built in. It allows us to do a couple different things. It allows us to, number one, pull any sort of long-term care charges and expenses out of that annuity completely tax-free. That's the first thing. The second thing that we get out of the Pension Protection Act is in the event that your client ever needs to utilize those dollars, and most of the time these are lazy dollars the client's not expecting to use anyway. If the client wanted to pull those dollars out of that annuity to pay for care, those dollars come out tax-free. So keep in mind, it works exactly the same as the old annuity. If she wanted to, if let's say mom wanted to go out and buy a car, if she wanted to go to Vegas, if she wanted to fund her grandkids' college, she's still going to be taxed on it. But in the event she had a PPA compliant annuity, it would wind up being tax free. In addition to that, just to drill down a little bit further, you're still got, if we compare a typical growth style annuity to a Pension Protection Act annuity, they're really going to look almost exactly the same. You're still going to have tax deferred growth. You're still going to have access to money. It's even going to be taxed, or it's still going to be taxed exactly the same in the event of death. But again, if it's needed for long-term care expenses, here's where the teeth really come into this. Now, we have a tremendous product line actually at OneAmerica that we call Annuity Care. We have 3 different products. We have number one, we call it Annuity Care One, which is really a fixed annuity. So in the event that you're not able to use an indexed annuity, this is one of those strategies that we use here, but the indexed annuity works phenomenal. We can either do that with the base annuity, or we can add the continuation of benefits extension rider on there for a little bit extra coverage. We're going to talk about how both of those work. In addition to that, we also have another product that I love. It's called Annuity Care 2. It's very simple to understand. It's going to be the industry's best leverage available, and we get that leverage immediately. So let's roll into this and we'll talk a little bit about how this works. First of all, if we're talking about Annuity Care One or the indexed annuity care product, typically I'm going to lean towards the indexed annuity care product, except if we're not able to use index products. Then I'll shift over to Annuity Care One. What we're able to do with just the base annuity, again, we're not putting the extension rider on there. What we're able to do is issue these clients all the way up to age 87. Now, our target market for this is really 75 to about 87. And these are for those clients who did not purchase long-term care in the past, or they have a highly appreciated non-qualified annuity that wound up on that asset identifier saying, you know what, in the event that we ever need care, this is where we're going to pull that money from. We're going to make that more tax efficient by shifting that money from one pocket to the other. It's still going to look and feel exactly the same, but when the benefits come out, it's going to be totally tax free. The other thing I love about this is, let's just say that mom bought this annuity years and years ago when she was young, before she met dad. Now they're both in their 80s, late 70s, whatever it may be. She has this old annuity in her name. We can now add dad's name on there as well. So we can put Mr. on the policy along with Mr. Mrs. So now we can put a couple on there, even though it wasn't originally set up that way. The last thing that I love is the fact that we also provide full claims concierge service. So everything that your clients could need in the event that a claim happens, we're going to be able to support the family, the healthy spouse fully across the board. Let me show you how this works. Now, since we are not adding a ton of leverage to the base annuity idea, this base annuity strategy, since we're not adding the leverage, we don't have to go ahead and underwrite this thing tremendously. So if you take a look right here, this is our knockouts. If your client is not claim eligible already, if they don't have things like Alzheimer's, Parkinson's, HIV, and there's a number of other things on here, Lou Gehrig's disease, they're not currently in using a dialysis machine or a wheelchair. They're going to get the policy. And the best part about this, in my opinion, this policy, these applications don't even make it to the underwriter's desk. They come into OneAmerica. Our case managers look at them. If you have no's marked all the way across on the application, the policy is automatically issued immediately. So I love this idea. Now, if the clients were to take these dollars, here's the mechanics kind of behind what the actual dollars would look like. Again, this is our base annuity care or base indexed annuity care. And the example that I used here, it's a 77-year-old female. We're putting the money in. It's a $200,000 single premium that we're putting in, and really we're paying this thing via a 1035 exchange. This is that one that mom bought years and years ago. It grew up over the course of time. If she were to put the money in today, at the end of the first year, her account value, her 200 grand would grow to about 212. If she were to pass, if she needed it for long-term care, if she were to pass away, the family would wind up collecting 210,000. And really, the idea behind this is that number one, we're going to get the tax-free growth. We're going to tax deferred growth. We're going to take tax-free withdrawals on this thing. We also have a step up. It's a 1% bonus per year for the first 15 years your client holds the policy. So in the event they hold it for 10 years, they're going to get an extra 10% on top of their growth of the policy. Like I mentioned before, instant approval. We have 10% liquidity. So if the client ever needs to take some money out, they can take out 10% a year. If this, and let's just say, best case scenario, they hold this thing for a number of years, mom holds it for 10 years, that 200,000 has grown up to almost 400,000, completely tax-free. Again, all that gain that has grown up in that annuity over the course of time would normally be taxable if it sat in that old annuity. But since we're just doing a conversion over into this PPA annuity, now that 400 grand is now tax-free if she wants to use it for care. And she has access to 50% of it per year. Now, is mom going to need 16 grand, 16.5 every single month? Probably not. Maybe, but probably not. And if she doesn't need it that much, not a problem. Maybe the cost is 8 grand. And if that's the case, slow it down, and you can stretch out those payments and make it go from a 2-year policy to as long as you want. Just stretch it out as long as you need. Pull it out as slow as you need. But I love this idea right across the board. Here's what it looks like from when we open up the ledger. So when we take a look at the illustration, you're going to see, and this one I ran as a couple. I mentioned earlier that we have the ability to add a spouse in the event that mom says, hey, you know what? My husband doesn't have any coverage. Let's go ahead and add him on there as well. You'll see on the projected illustration, $200,000 is what goes in. It would be $6,700 per person per month. This is going to stretch out because we're putting a spouse on there, actually 30 months. So they'd be able to pull out $6,700 per year in the event there was a long-term care need in that first year. Chances are they're not going to need that. Let's go ahead all the way out to age 85. In the event they were to pass away, we would be able to send $329,000 to the family if they needed it for long-term care. $362 would be available, and the monthly amount that they can pull out, almost $12,100 per month. So I love this idea, especially for your older, unhealthy clients, for your clients who don't like the idea of underwriting. Maybe you don't like the idea of underwriting. And if that's the case, this is a perfect idea. This also works out great for single premium life cases that maybe you've taken somewhere else, but the client was declined. If maybe they were declined at the competition, and you say, hey, we're not going to be able to get this client through anywhere. What if we take that money over to OneAmerica? We put it in here, you get the tax deferred growth, you get to pull the money out tax free, and you get to step up as well. So, this concept, in my opinion, hands down, it's huge. And this is one of our biggest sellers last year. Now, the other idea that I love within the OneAmerica line, we call it annuity care too. This is a it's a simple fixed annuity, very easy for your clients to understand. It's a very powerful product because it's got the industry's best leverage on there. And what I mean by that is that we are offering 4 times immediate leverage for anybody who's under the age of 70. So if it's, let's say, me who came in, I'm 54, I put $100,000 in this. Tomorrow, if something happened to me tomorrow, I would have 400,000 worth of long-term care available. Now, I realize that the competition does have some multipliers and some stuff like that. Not only is ours a little bit larger, but it's also not based on health. So if you have an unhealthy client who's younger, they're still going to get 4 times leverage. Now, if I happen to go ahead and come in with a spouse, I'm going to get a little bit less leverage. It's going to be about 3.6 times leverage, but I would have spousal coverage as well. Now, if we're talking about somebody who's a little bit older, and that's typically the demographic for these annuity care products, you're looking at closer to 3 times leverage, no matter what the underwriting, however underwriting comes back. You're still going to get about 3 times leverage unless you come in with a couple or with a spouse. Then it's closer to about 275 or so. Now, the way that we do this, let's go ahead and jump forward. The 200,000 that were to go in would be, you would have the existing $200,000 that would go in as cash value. And on top of that, you would also see a $600,000 continuation of benefits. What that's going to do is give you a total of $800,000. Mr. and Mrs. can pull this thing out. Actually, in this case, this is just Mrs. $8,300 a month, and it would last her 96 months. So I love this idea. When this money goes in, the 200,000, if it were to go in, I've got a younger couple here. They were both, and this is actually a live case that we're currently working on. They had an annuity. This annuity's grown over the course of time. It was about 215, if I remember correctly. And the money that goes in would wind up, and you'll see the joint equal age on this thing. They're young. They're 53 years old. If I remember correctly, they were wanting to get an annuity, or they were wanting to get asset care. The woman had not been to a doctor in years, so we were going to wind up doing a blood draw. She didn't like the idea of the blood draw because she didn't like needles. That's why she didn't go to the doctor in the first place. So we pivoted to annuity care. Here's the other thing that I love about annuity care is that any of our annuity care products, if it has that continuation of benefits rider on there, we are never going to pull an APS. We're never going to send somebody out for a paramed. It's going to be done directly off of the application. Underwriting is going to be done directly off the application and off a phone call with the client. At the end, we're either going to approve, we're going to decline, or we're going to move forward. But for this couple, they put about $200,000 into this. Right off the bat, they're going to have about $730,000 in the event that they ever need care. Not going to happen in the first year. So let's fast forward to, let's say, age 87. They're still going to have a really big death benefit. That accumulated value is going to grow to over about $450,000 in the event that they need liquidity. They need to pull the money out. In the event that they never needed it and they passed away, that 450 would go back to the family. It would be an annuity, it would be taxable, but it would go back to the family. Now, in the event that they needed it for long-term care, which is probably a little bit more likely, their long-term care balance at that point would be over $1.5 million. So very, very significant plan just from identifying what we saw on that asset identifier, shifting it over. Now we've gone ahead and created almost $1.6 million and it's completely tax-free when that money comes out. So Annuity Care 2, very simple, easy to understand. It's got a 3.5% rate right now. We slowly pull out insurance charges out of that every single month. And we wind up, and for those insurance charges, you're going to see that leverage on there. And that's also why you're going to see the account value doing what it's doing right now. So if you have any questions or concerns about this thing, love to show you how this works, but it's really simple and easy to understand. Now, let's move a little bit forward. And I mentioned the annuity care product and the indexed annuity care product are similar products. One's fixed, one's indexed. We talked about the Annuity Care 2 product, which has the continuation of benefits baked into it. Now, what we can also do, and this is a little bit of a different strategy, we talked about the base annuity before. This is just an indexed annuity. It's going to grow over the course of time. But in the event that we wanted to go ahead and add extra leverage on top of that annuity, the other thing that we can do is add a continuation of benefits on there for an additional premium. Let me show you how that works. Now, in this situation, we have a 75-year-old male who liked the idea of that base annuity, loved the idea, had that existing highly appreciated non-qualified annuity, wanted to move the thing over, took a look at this number here and said, you know what, it's going to grow to $362,000. I love that. I love the fact that it's tax-free, but both my parents had dementia. Got a lot of concerns. Parkinson's in the family. I don't know if this is quite enough for me. Excuse me, guys. What we can now do is also on that original base annuity that we talked about, for an additional annual premium, where you can bake that premium into that 200 grand. But the best way to make this happen is you pay an annual premium over the course of time for the continuation of benefits. Not only will you have this 362 from the existing annuity that we have, the base annuity, but in the event it is exhausted, then we can move to the continuation of benefits. We can do a 30-month continuation, which would add an extra 30 months, as it says, an extra 60 months, so an extra 5 years on top of it, or lifetime coverage, unlimited long-term care. We're the only ones that are still doing this in the industry. And you'll see off to the right, if you wanted to send an additional annual, almost $4,000 premium, we'll go ahead and give you an extra 30 months. The 60 months is $6,500. The unlimited, this is our Cadillac. They will continue to get coverage for the rest of their life after that 360 is spent for an extra 10,300 a year. Now, keep in mind, this extra COB premium, a lot of this can be tax deductible. So if you have a client who maybe has an old HSA, you can use HSA funds for this. If they are a business owner, a lot of times this is tax deductible as well. So keep that in mind when you're talking to your clients. Fantastic idea to go ahead and add that COB on there. Now, again, we mentioned earlier, we had those 4 knockout questions on the base annuity. If we do add the continuation of benefits, then it would shift to underwriting that would look similar to the Annuity Care 2, where we then move to the application, which is the full app, and the phone call at that point. If your client gets through, no problem, we issue the policy and they're taken care of forever. So that kind of really wraps up what we're doing from the strategy standpoint. Over at OneAmerica, again, I love this product, love what we're doing, love the way this looks. So please keep us in mind for any of those non-qualified annuities. If they happen to show up on that asset identifier, we'd love to talk to you about them.
Thanks, DJ.
Yeah, Josh.
Yeah, so let's bring it back full circle to the Pension Protection Act, right? So, I think that we can all agree that the worst kind of tax to pay is ordinary income tax, right? So if you think about all of the accounts that your clients have, and you think about, hey, what's the tax consequence if you reach into that account and pull $1 out? Your qualified accounts and your non-qualified annuities, they're the highest taxed assets you have. So if you don't need them, you don't want to spend them. So instead, you stick them over in the corner, you hope you don't have to spend it, and they collect dust And in the event of an emergency, I've got my annuity over there. Well, if the emergency is what happens if I get sick and I need care, why not repurpose that non-qualified annuity we don't plan on spending, utilize the Pension Protection Act, which, if we take advantage of OneAmerica's Pension Protection Act compliant portfolio, we've learned can basically be 4 knockout questions. And those questions are basically around, are you receiving care now, essentially? And so we can instantly, by taking that annuity from the non-compliant traditional non-qualified annuity, 1035 exchange into the pension protection compliant annuity, the gains instantly become tax-free for long-term care. And then if you choose the index option or you choose the fixed annuity, it's got growth that will raise the account balance, which is also gain that can be used tax-free. So, anybody who fills out that asset identifier or who has that non-qualified annuity they don't need for retirement, we should consider what this looks like. How do we repurpose that, create a bigger pool, protect the other accounts, and protect the assets that you manage? So, as you can see here, you can download a material or a brochure we put together on the Pension Protection Act, or you can actually just reach out to myself. And here's that information, obviously, and we would be happy to help you. So with that, DJ, thank you very much. Thank you, everybody, for joining us. And, listen, let's go help our clients protect themselves against the risk of long-term care, right? That's the thing that's keeping our clients up at night. So with that, everybody have a great day. Thanks so much.